Good morning, everyone. Welcome to another rundown of global stock markets. And it's been another week of extreme movements. Some of the intraday volatility is just stunning. Some of the reversals that we see within the one trading session. These are some of the trickiest conditions that I've seen in the last 20 years. So it really is reflective of just how distorted global markets are in numerous respects. And yeah, it's making trading and investing quite tricky, and it means that if you are continuing to use the methods that you may have used and most people have used over the prior decades, that they're probably not being too productive at the moment. So let's get on and have a look at what happened last week. Just before I do, actually, I'm running. You may recall that I ran a live event in Perth last Monday night, and I'm going to run a webinar on Tuesday evening covering that same material. And I'm really looking at the question of whether all this extreme volatility presents a danger or does it present an opportunity? Then the obvious answer is that it's really a bit of both. So it's going to start at 7:30 Eastern Standard Time, Eastern Summer Time, and it'll provide a lot more color and detail than what I can cover in these weekly videos, where I am aware that there's a bit of a time constraint on these videos. People don't want to watch really long videos. I'll provide some more detail on that at the end of this rundown. So let's look at American stocks first of all. The S&P had another good week, rose by 30 points, and we've got a mixture of both positive and negative indicators. So the market is in a position at the moment where it could really go either way quite easily. We saw resistance at 1950, 1945, 1950. We saw that breached on Thursday, and then the market went higher on Friday, but then turned around and came back and retested that level. So in the very short term, the market is between extremes of oversold and overbought, and therefore could go either way. Almost impossible to pick. Over the course of this calendar year, there has been an almost 100% correlation between the direction of stocks and what oil and junk bonds have done. And that correlation has been so complete that the changes in direction are almost identical down to the nearest 5 or 10 minutes. If the price of oil or junk bonds moves, then that is reflected almost instantly in stock prices, and I can't ever recall having seen that sort of behavior before. So this really is groundbreaking sort of stuff. And we're seeing, as I mentioned at the start, we're seeing very significant intraday reversals. They're becoming a feature. There was an amazing reversal through the week where the market was off heavily over the first hour and a half, and then turned around. I got up the next morning expecting the market to be deep in the red, and I got up and it was deep in the green. Just absolutely stunning reversals intraday. And that was another example where the price of oil turned around from being negative to positive, and stocks just went along for the ride. So just looking at those shorter term considerations, the conflict between negative and positive signals, one of the negatives for me is that the banking sector, not only in America but globally, and certainly here in Australia, remains a major relative laggard along with energy. Now, yes, the banking stocks have gone up a little bit globally over the last week or two, but relative to the main index, so in America, relative to the S&P 500 index, and relative to just about all the other sectors except energy, banks have gone up less. And as they've been sold down quite heavily, this is a particularly negative sign when, for a healthy economy and a healthy stock market, the banks should be doing well, and very clearly they're not. And you may recall last week, or it might have been the week before, I can't remember, but I put up a graphic of the comparison of bank performance for the first 6 weeks of the year in 2016 compared with 2008, and the banks are doing substantially worse than they were in 2008. Another negative for me is that whilst there's been some fairly impressive price rebounds since the market turned around a couple of weeks ago, the volumes have been declining fairly quickly on the general advance. So this is hardly a rally that's got a lot of conviction behind it. So I see that as a negative. But there are a number of positives offsetting that. Firstly, the market breadth is improving. There are more stocks that are now trading above their 50-day moving average than what we had a week or two ago. So that's a definite positive. We're also seeing rotation into some more of the aggressive sectors. Money is coming out of consumer staples and it's going into consumer discretionary stocks. It's coming out of utilities and it's going into industrials and even materials. You know, some of the commodity sector is doing quite well. So that rotation into the more aggressive sectors is indication that people are prepared to take a bit more risk. Also, oil is really in a trading range, and I'm not predicting anything's going to happen here other than that it's going to continue within this trading range. But it does appear to have some further short-term upside within that trading range. And of course, with oil and stocks linked almost 100%, then that could fuel a bit more upside for stocks as well. And also credit conditions seem to be easing a little bit. There's been a lot of pressure on the bond market, and that just seems to be easing off a little. So again, that could be a positive for stocks. So we've got a real mixture there, and you could seize on any one of those and say, aha, the market is going in this direction. But I think you've got to look more broadly than just seizing on one or two indicators. So let's have a look at the S&P. So we'll start with the monthly chart that we've been looking at now for a couple of years, and because it just gives you a really good big picture perspective. No question, the market character has changed. I think the way all things look at the moment, I think it's incredibly unlikely that we'll see the market create a new high anytime soon, above 2130. I just can't see the circumstances where that can happen. So I think we have one of two outcomes. We either have a trading range, perhaps forming a lower high here somewhere between 2000 and 2050 points, or alternatively we break down from this support around the 1820 mark, and that definitely brings into play a retracement of the long-term uptrend. This is 2009 at the bottom of the GFC, and if we were to get any sort of reasonable retracement, then we could be looking down at 1578, which would bring us down to precisely the 2008 and 2000 peaks, and that would be a deep correction from where we are at the moment, and that would be very, very scary for a lot of people, but it would not be abnormal. When you pan back and take a big picture look, that would not be abnormal for this massive trend from 2009, 7-year bull market. If the bull market is now going to go into a cyclical bear market, which I think is entirely possible, then a 38.2% retracement of that advance would be perfectly normal. So, you need to recognize the potential downside could be significant. Now, I'm not saying that this level will break and that will happen. I'm not saying that at all. But your mind has to be open to that possibility. Let's zero in a bit, look at the daily chart, and you can see if we just pan back and take a bit of a broader look, we're coming off the lows of 2014 and then also the lows of mid-January. And it's been a pretty good rebound, and you can see the retracement of this run from December down to the lows in January. So basically the move of this year, we went up to the 50% retracement level, which was at 1946. We came back down, we did an exact retracement, or we did an exact retest of those January lows. And then on Thursday, you can see in fairly robust fashion, we broke above that 1946 level. Market went on with it on Friday, got up to a high of 1963, and then came back and closed back on that breakout. If I had to toss a coin, I think there is probably a bit more upside in this market. I think we could run to 1978, possibly tuck in here underneath this 2000 level, which are these lows of the 14th of December. But, we'll just have to see how it goes. The RSI is right in the middle. This market could go either way. I will say, though, if the 1810 level breaks, you will see a torrent of technical selling, and there'll be a very sharp move to the downside because there's just so much pent-up energy and short selling that would come into play if that occurred. So that's where the potential dangers are. Let's look at the NASDAQ index. Not quite as strong as the S&P. You can see it only made it back to the 38.2% level. We tested the January lows, in fact went below the January lows, and now we haven't got back. The S&P on a relative basis is up here somewhere above just on the 50% retracement level. So the NASDAQ in this calendar year is underperforming. Let's look at the Russell 2000, and we've got, you can see, very similar kind of pattern here. The Russell 2000 is underperforming the other two. It's further below the 150-day moving average. I think this might actually be, that's a 200-day moving average. Let me just check that. Sorry, just checking. No, it is a 150-day moving average. Sorry, I use different ones on different charts. So we've got some potential retracement targets: 104, 10, just under 107, and 110. So what happens over the next few weeks and how far this runs will give us a good indication of how much follow through there is. But you can see the way that the volume is declining as we get into this rally. Volume's falling away quite sharply. Finally, I'll just have a quick look at the US dollar index. Has been pulling back from a big double top at the start of December, but just in the last week or so has picked up again. So we're tending to trend back up again, which really does make the performance of gold all the more impressive, because gold has done extremely well even though the US dollar has gone up. So gold is decoupling from some of the things that it normally would trade in accordance with. It's decoupled from the US dollar. It's decoupled from the stock direction. Normally it would be going in the opposite direction to stocks. And there's also a bit of a relationship there with oil. It seems to have decoupled a bit from oil as well. Now, while we're here looking at currencies, I'll just look at the Australian index, the Australian currency ETF, and you can see we've still got a downtrend in place. The 150-day moving average is still heading down. The price of our currency is still basically below it most of the time. Just had a bit of a look over it in the last couple of days, but as you can see, closed down on Friday night quite sharply. And that's really just consistent with some money coming back into commodities. Iron ore had gone up, got to just above $50 a ton. Oil has bounced back a little bit. Base metals are up a little bit. But look, I don't see any of these commodity moves as being sustainable. I think they're all just counter trend rallies within an overall downtrend, and therefore when that's run its course, might be a few weeks, a few months, I don't know. But when that bit of a counter trend rally in commodities has run its course, then I think you'll see the Australian dollar resume its downtrend. It'll almost certainly test this 69-cent low. And most of the commentators, I'm not a currency person, but most of the commentators who I respect, their view on the Australian dollar are still saying mid to low 60s. Just have a quick look at the Australian. We'll just go back to the slides. So the Australian dollar finished flat at 71. So looking at Australian stocks, the ASX 200 was down by 73 points on the week. So even though the American market was quite strong, our market, and I don't think it'll do too much on Monday, our market was down quite sharply. So there's quite a decent trend downwards, as we'll see on the chart in just a minute. The trend remains down, and the index remains in the middle of the channel. Therefore, in the short term, it could go up, could go down, but the medium term to longer term trend is definitely down. What we saw over the last 3 or 4 weeks has been a rotation of money coming out of the banks, which form about 40% of the ASX 200 index, and they're rotating into the mining stocks. But because miners now only represent about 15% of the index, then that's why the index is going down, because the banks are having an outsized impact on that. So that's a bit of a, that's a bit of a concern when money's coming out of the banks and going into miners. So 46.50 is still the next support target for me. I said, I've had this comment now for a couple of weeks. I said after a bounce, we've had a couple of weeks to look for a bounce, and we haven't really had one. The American market has bounced very hard over the last 2 weeks, but our market has failed to do so. So let's just take a look at the Aussie market. We'll look first of all at the mining index. So you can see overall we're in downtrend. The red line pointing down, the value of the index is below the moving average. So clearly in downtrend. However, we do have a short-term uptrend, which really started when the international markets reversed at the start of February. So short-term uptrend there, but you can see that we're still just within a basing pattern on the mining index, but definitely short-term uptrend. Let's look at the banking index. So again, you can see banks are in downtrend. They've rolled over now. That rollover really occurred about the middle of last year, and you can see the moving average is heading down, and clearly the banking index is forming lower highs and lower lows. So if you own a considerable amount of banking stocks, then you've just got to step back and recognize that banks are in downtrend. And the banking index has dropped from around 7,200 points to 5,400, 5,500 points. That's a fairly substantial correction, and the trend is down. And you can see the banking index is well below that moving average, so it's indicating strength in the downward trend. We've broken some important support. We overran it by a bit, then we retested it and overran that by a bit, which quite often happens. But I think 5,100 on the banking index is a distinct possibility. So clearly that index is down, and you can see in the shorter term, as opposed to the mining index, that we've got a downtrend in banks, lower highs, lower lows, whereas the materials index is going the other way. So if you wrap all that up, let's look at what the overall Australian index has done. You can see there's a very, very clear downtrend channel in place. The moving average has rolled over very sharply. So this is pretty much consistent with the banks. And over the last 2 weeks, our index has really gone nowhere, while the American market has gone up quite strongly. However, I will say that some niche stocks in Australia still are in uptrends and still represent opportunity. So you want to resist looking at the ASX 200 and assuming that every stock within it is going in the same direction, because quite clearly it's not. So this is a real stock pickers environment. While we're here, let's look at gold. Let's look at the daily first of all. So we've broken out of this downtrend, rallied above it, come back, done a retest. We're just consolidating around here. Gold in the short term had gotten overbought. We're getting a bit of a retracement of that, which is perfectly normal and healthy. We might come down a little bit further. Time will tell. If we look on a weekly, you can see that gold has certainly made an advance. We've broken that resistance line, and I think it's safe to say that in all time frames now, gold is basically in an uptrend, short, medium, and long term. So gold was just a tick lower for the week, $7, and that all occurred on Friday night, and that was really just a bit of strength in the US dollar. But we do have a confirmed breakout on all time frames. And also stocks are outperforming, and that's an important thing. So let's look at the HUI index. So dragged down a little bit on Friday night, but you can see, looking at the HUI index in the States, you can see that there's been a very significant breach of that downtrend. We've shot up through this resistance level, went straight through it pretty quickly. The 50-day moving average is about to cross the 150-day moving average, and it's looking extremely strong at this point in time. Short term, overbought, so a bit of a pullback is perfectly normal. So we'll just have to see where gold stocks go. But I really see the potential for gold stocks to run quite a long way. And the other point I want to make is that that there's a long run relationship between the gold stock averages and the price of gold itself, and that ratio has dropped to had dropped to an extraordinarily low level. It was about 1/3 of what the long run averages would indicate. And all financial markets do revert to the mean over the long run. And so I think a return to that long run average is inevitable. However, I'm not saying when that might occur. Could be 6 months, could be 2 years, could be 5 years. I'm just making the point that there is a long run average that will come into play at a point in the future, but that gold stocks have enormous rebound capacity relative to gold. So gold doesn't need to move from here. At $1,200 an ounce, Australian gold miners in particular are extremely profitable. So even if gold doesn't move, the potential for rebound in the Australian gold stock market is substantial. But there's also some extremely good, attractive opportunities in America as well. Copper firmed up a bit to $2.14, consistent with the general moves in commodities. Crude oil steady around 33, but still very volatile on a session by session basis. And I think we're going to be stuck in this range between 26 and 36 for a little bit. We saw a classic liquidation climax in the selling in oil occurred in November when it got down to $26 and something. But the advance since then has been of pretty poor quality as I read it, because the big volume days have been to the downside. The up days have been on lower volumes. So I'm not really too excited about crude oil either, definitely not fundamentally, because the world is still awash with oil, and I think the prospect of production cuts from Saudi Arabia or Russia or any of the other OPEC countries are almost nil. So fundamentally, I'm not excited about oil, and technically I'm not too excited about oil either. Spot copper chart, not a lot of change. It's just really in a range. So wrapping it all up, the overall strategic approach, I think, as I said last week, the only way to deal with this market is to work from the extremes of price and sentiment. Trying to work in the middle is really, really difficult. And I'm going to talk more about this on Tuesday night if you want to join me for that webinar. Don't stay in a position too long because there really aren't any trends at the moment. Gold is perhaps the only emerging trend, but that really requires, a bit more confirmation yet. I would definitely be taking steps to reduce the risk and the volatility in your portfolio because the volatility of the general market is quite extreme. Valuations still count. I've had emails from some members and also from some non-members asking me about this particular issue, about why valuations don't seem to matter a lot in the short term. Look, they still do, but trends and extreme volatility is just basically completely over trumping that at the moment. So from my perspective, ignore chart patterns at your absolute peril. I think it's pretty safe to say. So if you'd like more information, I'll be running a webinar on Tuesday night. The registration link for that webinar is below this video. So just click on that and that'll take you through to the registration area. What I'll be covering is what is driving markets in recent times. I'll be going into that in some detail. What that means for investing, specifically what things you can do to lower your risk but still target above average returns, and where are the best opportunities right now. There's certainly opportunities out there. There's danger, but there's opportunities. And I'm just going to wrap it up with some of the really key big picture things that I've learned over 3 decades that I can offer you. I think there's a lot of valuable learning in that. So just to wrap it up for non-members, there's my contact details if you'd like to get in touch with me. Basically, my business is about, yes, I provide recommendations very specifically, but really the essence of my business is about support, it's about education, it's about a sounding board, it's about all the things that are really important during extremely volatile markets, because it's not the recommendation per se. It's the really important issues are making the big picture calls and assisting people with execution, and that's really the key in these sort of markets. So that's it for this week. A bit of a lengthy one, but look, there's just so much to talk about these days, and hope to have you join me on Tuesday night. Cheers.